Certainly, it was a good indication that we're finally starting to get some traction on wages. There's obviously an inflation concern component to that, but it'll also likely give a second wind to consumers over the next few years. Job growth is going to peter out because there's just fewer people still on the sidelines available to be brought back in. So as we get a little bit better wage growth, certainly that's good for the overall pace and sustainability of this current expansion. So it was a very good report.
Anastasia, I want to ask you, I thought I saw it here, but I saw it somewhere else. The notion that, oh, here it is. It is in the journal. You buy into that? Investors fret profits are peaking. Why would profits be peaking?
I do buy into that because in absolute terms, they're not actually peaking, and we should still continue to see an ascent into next year. But if you look at it into year-over-year growth term, which is what the market is really concerned about, that we're not going to see a repeat of 24% year-over-year earnings growth that we see in this quarter. So we're going to see closer to 10, and that's one thing that the markets are concerned about. The other one is earnings revisions. We can talk about great Q3 all we want, but the reality is 2019 forecasts are starting to trend down, and the ratio of upwards earnings revisions to downwards earnings revisions is also starting to trend down. So that's really a key indicator for the market. So I'm not at all surprised that even though 78% of the companies beat, 1.5% negative is what the average price reaction has been in this great Q3 season. Mm-hmm.
We made the point that when you go up 24% one year, even if you're flat, you're still up 24% from 2 years ago, aren't you? I mean, isn't that a positive business environment, or does the market always crave more gains?
Yeah, the answer is the market is always forward-looking. So it's about the direction of travel. It's not about a level of something. And the direction of travel over the next few years, it's not just peak profits. It's also peak policy and peak positioning. So if you think about what supported the markets here for a number of years, is that the surge in earnings, surge in accommodating policy, and also investors that were still on the sidelines. But what we have today is the exact opposite of that. So what do you do amidst these markets? You just think about different positioning going forward, and they need to begin to gradually de-risk the portfolios with that sort of shift in sentiment in mind.
Is it margins are going to cause profits to peak? Because you could paint a scenario if the trade initiatives eventually bear fruit. Let's say it's not always bad. And you know, let's say that companies feel comfortable that the tax benefits that they recently got are going to be sustained, so that they can, and they actually start with business investment. Why couldn't corporate profits continue to be good? I mean, maybe margins are bad because the wages go up and
margins are phenomenal at the moment. They're 11.6.
But are they peaking?
I think they will. I mean, this is the highest margin that we've seen in the U.S. I mean, 30, 40 years ago, over 30, 40 years. And if you look at the companies, what they're starting to say is that wages are rising, input costs are rising, the U.S. dollar is rising. Oh, and by the way, tariffs are rising as well. So that's what we think will eventually eat into the corporate margins.
Let me get to Russell then. Russell, does the same go for GDP, that's peaking and headed lower as well? In your view, you mentioned the shortage of workers.
Right. I do think that GDP is going to subside here over the intermediate term. 3% probably was the pace that we've gotten to that could be sustainable for a short period of time. But especially next year, we are likely to see a stronger headwind from some of the things that you just mentioned, the stronger dollar and the tariffs. But still, if we drop back down to about 2.5%, that's still a very strong economic environment that importantly allows companies to continue to see strong sales growth. And the term peak earnings is used a lot. But again, it's about the peak in the growth rate, not the actual earnings. And I think that a good 2.5% growth rate for next year and close to maybe 1.5 to 2 in 2020 is still a good year for corporate growth earnings prospects.